Gary. And as indicated, we are now recording this presentation from Gary Siporski.
All right, thanks, Sandy. I tell you what, we need to get off on the right foot here this morning. And I don't know if you've looked on Facebook this morning, but today is National Milk Day. And I didn't realize that. And I don't know if you can see the screen here, and I've got a nice glass of whole milk with a couple of ice cubes in it to keep it nice and cool. So we need to get the day off right and get started in doing it. And my thanks to all of the dairy producers that are listening, and also all of the people that supply dairy producers that allow us to have the kind of nutrition that we do. So thanks very much. All right, with that, we're going to start out with some goals and an agenda. And really the bottom line here is what the discussion is all about, is to have a better financial understanding, particularly when it comes to your taxes. And I really like that question that you started out with. Who prepares the taxes for the accountant? And the second one is, does that really give you a true financial picture of what's going on your dairy? And that is just perfect for what we're going to be talking about. I've got a couple of things I just want to outline here, and this is what we're going to be discussing here today. First of all, of course, farm tax awareness, working with your accountant. We're going to be covering a number of items regarding to that. Why financial taxes and the taxes that you do and prepare for the IRS are different from other farm businesses. All of us are involved very much in the farm. We think, well, this is the way everybody prepares taxes. Well, not necessarily. We're going to talk about some specific sheets, tax sheets on the farm when we do the taxes. And next, we're going to look at what the farm taxes tell you and what they don't tell you. And that goes back to that question that we started with. And just how much can we rely on those farm taxes to making other farm management decisions? Because we are now in an era of making sure that we understand our numbers and just what they tell us and what kind of decisions can we make when we look at those, and can we really look at the taxes and rely on that? They're important, don't get me wrong, but does it really give us all the information that we need? We're talking about other farm-related financials to know. I'm going to end the program, things that you really need to be doing, particularly this time of year. We don't have cropping to do. Obviously, there's always a lot of chores to do on the farm, but there's other financials that are really important that you can work on now that you're looking at all the numbers as you're preparing things for the taxes. And why a better understanding is for their taxes now. What's important? What's important as far as understanding what's going on in the items that we can prepare as far as tax going. Now, let me start out with this comment, just so we all understand one another, that I am not an accountant, I don't do taxes, and I'm not a CPA. Now, you would say, well, now, okay, so why do we have Gary on the program? Well, I have spent 30 years working with many different farmers, helping them get prepared to working with their accountants, worked with many accountants, tax accountants, attorneys that do accounting work as well. And then helping dairy producers analyze the taxes once they get them completed and really what they say. In fact, when we get done with this program here in the next 60 minutes, you may have more questions than you have answers as we go through this. And I'm going to try to just get rid of the mystery that seems to be there when it comes to doing taxes and what you're preparing and what you're looking at when it's done. So many farms will take the taxes and bring it into the accountant, hopefully have a meeting ahead of time, but sitting down with those tax forms that you did last year and then looking at what you need to do this year, and you put those taxes and get them done, you get them back, you get them signed, and you give a sigh of relief. And a lot of people say, wow, good, you know, I don't have to pay many or any taxes, and this is good. And then we forget them. And then we go on to the next year and never think about it again. And I don't know how many tax accountants still get what's called a shoebox accounting system, and that's where people, at least in the past, they would have a box that they would bring in, or a manila envelope with all the receipts, the milk receipts and other receipts of income, and also all the expenses, and plop it on the accountant's desk and say, okay, here you go. This is everything that we did this last year. Just make sure that you do it and that you minimize my amount of taxes that we have. Well, today we have other programs like QuickBooks and other spreadsheets. A lot of times on a farm, we have farms themselves. Sometimes we have siblings. We have others that prepare spreadsheets, actual farm spreadsheets that are prepared. And spreadsheet is really a playground of doing a lot of different things with spreadsheets that can show just what our income and expense. There's a lot of professionally prepared spreadsheets. There's one nice one out of Minnesota called the Red Wing. Again, Farm QuickBooks. It seems to be a real popular one, but there's certainly many other good farm spreadsheets that are out there that we see today, rather than just doing things in a shoebox. Now, this year's a very interesting year, and it's going to take some good preparation to make sure we get all the numbers, because all of you are aware of the difficult year that we've had. And thank goodness that people finally have figured out that food doesn't come from the grocery store, it does come from the farm. And obviously the government has understood that as well, and that's why we've seen the many food box pictures that we see on the news. In fact, agriculture has gotten about $1.5 billion, that's with a B, in money that has been given to farms of all sorts to make sure that those food boxes are filled, and that people really now understand the importance of food and just exactly where it comes from. It may be surprising to some of you that 42% of the net farm income this year has actually come from government programs. And that means that we've had a lot of different programs out there. We've had programs like the employee retention credit. That's probably more in line with people that serve food rather than those that raise it on farms. I don't think many farms have laid off employees because they've not had the work. We've always seemed to have plenty of work on a farm. But you've had the PPP program. Now there's a lot of discussions, and you really need to have a good discussion with your accountant on this. And whoever is the lender that's prepared, or the bank or the credit union or the farm credit system that you've done the PPP program with, because some of these now are coming through and they're tax-free. In other words, you don't have to show it as income. But here again, that you really need to write this down. In fact, I'm going to encourage everybody to do an action list right now, writing some questions down that you need to talk to your accountant with and get yourself prepared. And that's one big key item that you need to look at, because there's been a substantial amount of dollars there. And also the CARES program. There's been a lot of money that has been given to dairy producers and agriculture in general. So make sure you get those items down and you know what they are. And you need to find out just what's taxable, what isn't, just what has to be in the expense. And I'll tell you what, there's just been volumes of information that have been coming out of the IRS and SBA when it comes to some of these programs, and just how they affect things. So you need to get that down and to make sure that you have a good discussion on that. And tax planning obviously starts with preparation. October, November, it's a good time to do it. Well, Gary, we're a little bit past that now, so we can't do that, but hopefully a lot of you did pre-tax planning with your accountants, because there's some items that we're going to talk about here in a few minutes that are extremely important with that. Most accountants obviously need an appointment, and it's important to get that appointment made in advance and making sure that you've got the correct information that you need for the accountant. So with that, Sandy, you've got in control of the PowerPoint program. So let's go to the next slide, if you would, please. All right, let's talk about this all-important person here that's preparing the taxes. This is May to the accountants. This is like on a farm when you're finishing up planting, doing the tillage work, getting the manure out, getting the cattle fed, getting that first crop hay up. This is when they put in 18 hours a day. They're extremely busy. There are just volumes and volumes, and monthly there's information that come to them when it comes to what types of things they need to prepare when it comes to doing taxes. And of course, with farms, we have 1st of March. In fact, now some of that has been extended to the April 15th. And again, you, when you do your taxes and work with your accountant, you'll know just exactly what your deadlines are. So let's go to the next slide, Sandy, if we would please, and let's talk about farms in general. And there's so many things that the accountant does, and you just need to understand this when you look at this plate. It's a verification of the financials, looking at the expenses, looking at the reports. Those of you that have a farm that actually has a corporation, 20 and 30 years ago, we had an awful lot of farms that got into corporations for good reasons. Today, most of them becomes LLCs, and that's what attorneys are suggesting. We need to look at the income, revenue that's coming in. And attorneys and accountants will ask you about management information, what's going on, what are you doing this year, what are you doing next year. That may have implication as far as putting the taxes together. On the asset side, again, if you're a corporation, this is going to be something that is going to be looked at as well when we come to depreciation of some of these assets, and whether your farm is based on a book value or a fair market. And we'll talk about just where balance sheets don't necessarily come into a view at all when it comes to doing taxes, unless you're a corporation. The credit, the amount of loans that you have, the interest that's paid, what's the deal with principal and depreciation. We'll get into those particular topics, the records that you save and keep for your accountant. So let's go into the next one, Sandy, if you would please. And I'm going to start out with this, the importance of you keeping good records and what's happening. And I'll start out with the checkbook, and you might say, well, you know, the checkbook balances, I can get that from the bank that I'm doing my checking with now, and I can see the statements online, so I don't really need to keep this track of that. You really still need to do that, because that's a reflection on just how the rest of the financials are prepared. Go to the next one, please, Sandy. Looking at your records, and go to the next one right away while we're on this one as far as record keeping. And, you know, here's an example of two different offices, and I don't know what your office looks like. And yeah, we can have farms that have a very neat looking office and things that are prepared in the proper place. The files are correct. And I've seen these both ways. I've been on farms and things can be a bit of miss and array, but that's okay. Sometimes this is just the way people do it, and keeping track of things. But obviously, with all the numbers that we're really dealing with today, I really encourage that people look at a file system where you've got things in the proper order, that you can see things where they are, you can get those done. A lot of farms now, if they're large enough, they'll have an accountant on the farm, or at least a bookkeeper, I should really call it, that's keeping track of things and getting things prepared for the audit and what's going on a monthly and a daily basis. So that's important to keep things looking right. All right, let's go to the next one then, Sandy, if you would, please. I am going to make this point probably a number of times, and this is the accuracy. Accuracy in the numbers. What you don't want to do is turn in a number for a feed expense, for instance, that's $80,000. That's not going to work. It's $80,152.62. The numbers have to be exact. All the numbers have to be right down to the exact number. And obviously on a Schedule F on the IRS, for the IRS, we certainly don't want those numbers to look too rounded off, because that's certainly going to trigger some possibly an audit when IRS looks at those numbers and say these just look too zeroed in, and that isn't going to work. So accuracy is extremely important. Okay, Okay, next one, please, Sandy. All right, agriculture is different. You may not even think about this today because you've been dealing with your taxes on a farm basis. The rest of the business world deals on a actual basis year in to year out. Agriculture deals on a cash basis, and really what that allows us to do is to make things like prepaid expenses. And by prepaying expenses, we can take expenses that are going to be for the following year, and we can put them into a 2020 year, even though they're for 2021. And obviously, what does that do? That will lower the amount of income because we'll have higher amount of taxes. And this is where pre-tax planning in the month of October is extremely important when you deal with your accountant. There's things like feed and crops and fuel, things that we use and we know we're going to be using come next year that we can take and plow into it. This really has a big benefit, of course, to people that raise grain, the soybean and corn farmers out here. They'll have a lot of expenses in a crop going year, and yet most of their crop may end up being in a bin and not sold for the next year. And that's fine, but how they're going to pay taxes if you would charge the farm for that grain that's in the bin and call it income when it really isn't income. So that's the advantage that we have on farms, to be able to do that, to be able to keep that on a cash basis that we can run back and forth with those expenses. The other thing that we see sometimes, in particular a year like 2014, we saw the income being deferred. There again, you need to talk to the milk plant you're shipping milk to. Some can and some will not be able to defer a milk check, and that seems kind of odd on any year when we need the income. But there have been years that milk checks have been deferred. The other thing we need to really keep in mind when we're doing our taxes, and that is that it takes 40 quarters in order to be eligible for Social Security. A lot of times dairy producers and other farms get to what they can see as maybe becoming the twilight years of their farming, and they really haven't thought a lot about Social Security. And 40 quarters is 10 years that the Social Security needs to be paid into, even though it's a small amount. But when it comes to Social Security benefits after someone retires, or the Medicare type part when it comes to the health insurance, that's pretty important. So that may be another thing that you may want to write down and talk to your accountant on. If you haven't been showing much profit, again, because of some of the things that we can do with farms being operating on a cash basis, but it's important that you have that discussion with your accountant so nobody is surprised when we get close to retirement. All right, next one, please, Sandy. And now we're going to be talking about one of the top sheets. This is the 1040 on the taxes. Now, there's a lot of things going on in this 1040. It's really a summary of what all of the different schedules and all the different tax forms that are within the body of the taxes. Any off-farm wages will be showed in there, and at the bottom of the 1040, you're going to sign that. And it says that, to my best of my knowledge and the way this has been prepared, this is a legal document that I am submitting to the IRS. And it's real important when that's signed, and accountants take that very serious to make sure things are done correctly. So this is the first sheet, but let's go to the next one. And this is probably more that we're looking at when we look at what we call the Schedule F. Obviously, we have income on a farm, and at a dairy farm, 95% of the income is going to be coming from the milk that's shipped. There will be some income, of course, from cows that we sell. There's calves. And many farms will actually be raising grain they're selling, corn and soybeans that are going to be sold. And this is all income. And we'll take a look at this on the next sheet if you would look at the next one, Sandy. And of course, after income, we have the expenses. Some of our big expenses that are going to be showing up on our Schedule F that we're going to be looking at in a few minutes is certainly feed is one of the big items that we see on farms. Labor is another huge item. Cropping cost is obviously some other big expenses. You look at those three, and that's a bulk of what's going on. There's a lot of farms right now that are looking at the cost of raising calves and whether or not they can raise it. They have the facility to do it. A lot of times we don't think about the expenses of that. There's been many programs and different universities and financial institutions that have now helped dairy producers sort through that and looking at what the expenses raising a calf is. Of course, that's all split up to be many different areas between labor and feed and housing and what have you. But there's dairy producers now that are taking a hard look at just what it costs to raise the young stock on the farm. And some of them are selecting calf growers in the state of Wisconsin to raise their calves. Others have actually gone outside of the state and are working with people in places like Texas and some of the other southern states where the weather may be just a little bit more comfortable for raising young stock, although as we look at this last year, it's been so far pretty decent. And of course, our veterinarian and so many of the other costs that are associated with a farm. So let's go to the next one, Sandy, and this really gets into the nuts and bolts of what's happening. And this, of course, is the Schedule F. I'm just going to point out some things on here that are extremely important that we pay attention to. When we look at the top portion here, and there's livestock that is being sold. This is livestock, maybe steers, other livestock that's being raised, and this deals with some of the depreciation that we have, and we'll get into this in a few minutes. And this is the top part is where that's going to be listed. We get into the other sales, item 2. This is where a lot of the income that we have in a farm is all lumped together. We have, it says livestock here, and this is items such as bull calves that are sold, produce. Now this is where the milk comes in here, grains, other types of products, and that's all lumped together on just one part. And this item 2 here, and we're not going to go through all of these items, but obviously this is a big part where most of the income shows up on the farm. And you really need to have this divided out. And particularly as we get into finding out where the true profitability is in the farm, this is where we need to have these divided out, even though from a tax standpoint, that's all bundled together in one part. We look at different agriculture programs, and again, with the different programs that we have, you're going to have many dollars that are going to be in this particular category. Commodity credit, crop insurance proceeds will be in here as well. If you do custom hire work, that's going to be in there as well. And then, of course, it's all going to be summed up when it comes to gross income. When it comes to expenses, and on most farms, it's anywhere from 65 to 85% of the milk check ends up in this category, and this is the expense category. And this is where you need to be extremely accurate. You need to get this done correctly, and for your own in-house use, you really need to have these down. There's a big item here that we need to understand and we need to discuss, and that's a depreciation. This is an item that is a non-cash item, yet the 179 on a farm is really used to adjust a lot of the income. I mean, again, it's a non-cash item. Here's an example. And a lot of times this is used to limit the amount of taxes that are being paid. Now, there's two kinds of depreciation. I want to separate this right off the beginning. First of all, and I'll go back to that Schedule F again, Sandy. We were still talking about that. One part of depreciation, and that is the ones that we use for the taxes. And the 179 allows dairy producers For instance, let's say you sit down with your accountant in October and the accountant says, wow, you're going to have quite a bit of income. Why don't you go out and buy a piece of equipment? Yeah, well, you know, I've been looking at that tractor, so let's buy a $200,000 tractor. And the 179, and you may be able to depreciate that tractor in 1 year. And you say, well, this is good. I can use that tractor. I'm going to put it against my depreciation on my taxes. Therefore, I won't have to pay as many taxes. But you know, I don't have all the money to buy that tractor, so I only have a $50,000 down payment, so I'm going to have to borrow another $150,000 from the lender. And you go into your lender and you tell them you met with the accountant, and they say, well, that works fine. You know, we can certainly do that. So you do the loan, and you've got monthly payments now on that tractor, and everybody feels good about it. Well, the next year you go back and do the same thing, and the accountant says, well, you need to buy something again because we need to have more depreciation. So you go out and buy some planting equipment, and we maybe borrow another $150,000 on a new planter. And well, again, we don't have the money to pay for that, so we go borrow most of that money. Well, that's on payments again. Then we get in the third year, and oh, now don't have enough money there to buy that. So, but again, to keep my taxes down and put some more depreciation on there, I'm going to borrow the money. You see where I'm going with this, don't you? We do this for about 5 years in a row, and yeah, we've got some nice equipment, but it's on payments. And now we hit a year where the milk price is low. And all of a sudden we've got a whole bunch of extra payments here. And it's very difficult for us to make these payments. Now, we need to take advantage of the depreciation, but again, this is tax depreciation. And there's another depreciation that we need to understand, and that's called functional or economic depreciation. And if we buy that tractor for $200,000 and depreciate it in 1 year, well, we know that tractor is going to last longer than that, 5 to 10 years, depending on what your trade in and how long you're going to keep that. So that's an item that's used an awful lot when it comes to tax planning, and it can be dangerous. So you need to be careful with that. You need to talk about that with your accountant, and you need to make sure that the decisions that are being made are sound. The other item that is not showed on the taxes, that's a pretty important item, and that's principal. And I think everybody recognizes that principal never shows up on taxes because principal is a return of borrowed money. Now, ideally, it would be nice if the depreciation on the Schedule F was equal to the amount of principal that is paid back to a lender. And I can tell you from experience that doesn't happen very often. And sometimes it's really a wide gap. And the idea is that the depreciation comes out of the checkbook. The principal comes out of the checkbook and not the depreciation, but the principal certainly is part of the cash flows that we'll be talking about in a few minutes. So take a look at your farm and look at this year when you're working with the accountant. When you look at your principal and the amount of depreciation that you're taking on your taxes, just how close are those and do they make sense? All right, let's go to the next one, if you would please, Sandy. And there's another section that is filled up here on your taxes, and it's called 4797. Switch to the next one, please, Sandy. And this is livestock and machinery. We raise dairy cows on a farm. We raise those baby calves from day one all the way to freshening, and then finally, no, go back again. Yeah, there you go, Sandy. Thank you. The 4797, that's where we need to be on this. This is where the cows show up. Now you've raised those animals from day one, so they have been basically taken off as an expense, and now they're pure income. In fact, there's also animals that you may have bought. There's dairy farms that do buy cattle to fill in because they don't have enough animals that they've raised, or maybe they've expanded and bought some additional cows. And those cows are anywhere from a 3 to 5 year depreciation schedule. If let's say you bought that cow and it's a 3-year depreciation schedule and you sell it in 1 year after you buy it, well, you haven't totally depreciated that cow. So now some of that and you've sold that cow maybe for a profit. Hopefully you just didn't sell it as a cow, but you've sold it as a profit and hasn't been totally depreciated out. That's going to be here. So you need to talk to your accountant about items such as that. I mean, animals that are raised on the farm are going to show up as total income, total capital gains. Other items, machinery. I go into that $200,000 tractor. If you sold it after about 3 years for whatever reason, and it's been totally depreciated in the first year, you bought it for 200, you sell it for 150. Now you might have $150,000 capital gains on there. So you really got to be careful, and this is really takes some good tax planning to be able to do this and do it correctly. Again, good discussions that you need to have with your accountant. All right, let's go to the next one, Sandy, if you would, please. And Gary, you've gone through all this, and you told us that the depreciation, and we got prepayments, and we've got items that we bought for 2020, and they're not going to be spent until 2021. So if we do all this on the taxes, I sign this, how come the lenders want to know the taxes? If this really doesn't give me a true picture, and that's a point that I want to make at this point. The taxes does not give you a true picture of what's going on in your farm. What you've done is you've satisfied the IRS obligation. And can I use that tax return to run my farm? No, you can't. Now that's why your lender is going to ask you additional questions. And when they look at the taxes. Now, because the taxes are a legal document that you sign, that's one item that the lender can look at and start doing their financials, because you borrowed money from them. They have a fiduciary responsibility to see just what your profitability is. It gives them a starting point, but it certainly doesn't give them everything that they need. Sandy, go to the next slide, if you would, please. And really if you want to do this right, and this is a time of year to do it, and this is really what the lender is looking at, and this is what you need to look at as a dairy producer. You need to do a balance sheet at year end. Dr. Kevin Bernhardt and I are doing some programs right now for the professional dairy producers regarding financial literacy. And the 28th of December, you need to sit down and do your balance sheet. This has nothing to do with your taxes unless you're a corporation. But if you really want to run your farm properly, because we've just established the fact that the taxes is just a very poor indication of what your farm profitability is. You need to sit down on the 28th, 29th of December. You need to get all your inventories of crops and cattle and feed and machinery down. And on the 31st of December, you need to put all your numbers together, all your assets that you have and all the liabilities. And so obviously you can get the liabilities from your lender, and you know bills that are outstanding. You need to put all that stuff down, and you need to look at the net worth. The important thing is you need to do that balance sheet every year on the 31st of December. Because as you have changes, such as cattle inventory from one year to the next, we call that an accrual adjustment. And this is now, when you put your tax information together, you need to do on your farm a cash income statement. And the cash income statement is going to look at functional depreciation, just what the depreciation, true depreciation is on your farm. And that isn't going to be the same as that in your taxes. It's going to be looking at inventory changes between feed and cattle, and just what prepayments have been. Those adjustments have to be made on that income statement. And if you're not familiar with doing an cash income statement year end, you need to talk to your lender. There's consultants that can help you. Extension can certainly help you. But you really need to get a good look at just what's happening on your farm. And you need to do that income statement, because you can't run your farm based on your taxes and that tax return. It's important to do. It needs to be done accurate, but you need to run your farm based on the cash income statement. Now to go to the next one, if you would please, Sandy. And along with that, you need to do projections for this next year. And some of you might say, well, Gary, I don't see any sense of doing a projection. We have to get up in the morning. We have cattle to feed. We have cows to milk. The rest of the year, we've got cropping to do. My day is pretty well laid out for me. Why do I need to look at doing a projections? If you haven't figured that out, based on what's going on this last year, with the huge amount of volatility we've had, you really need to sit down. Once you've done your taxes, you've got a lot of your numbers together, and then you need to do your cash income statement. And again, based on the balance sheets from one year to another, and looking at those accrual adjustments, and now you do the cash in projection, and now you don't look at depreciation at all, you look at principal. You have all your expenses that you anticipate for this next year, plus the principal that you're going to be paid, because this is now a cash income statement. Think about this as money that goes into the checkbook and money that comes out of the checkbook. But this is the way that we need to run our farm. Go to the next one, please, Sandy. And when you've completed that income statement, now you should have a true picture of what the cost of production is. And obviously here at the end, I'm getting into some items that we can talk session after session on as far as doing, but particularly if you're going to do any marketing, you need to know what a true cost of production is, and you need to base that on a cash income projection that you're looking at. There's plenty of government programs, and we don't need to go through all of the acronyms that are out there that do help, giving you somewhat of a baseline and some assurance of income for this next year. Dairy producers have been able to take advantage of that this last year, and it certainly helped things out. But as we work forward and go forward, we're continually going to have volatility. So you need to know where those expenses are going to be. You need to anticipate them. It isn't going to be exact. Don't get hung up on doing the small items. Make sure the big items are correct, but get those items down and figure out just exactly where that cost of production is on the farm. And let's go to the next one. And you need to work with brokers if you're going to do, but you need to educate yourself if you're going to do any kind of marketing. Please don't go into a marketing plan blindfolded. You need to understand what's going on. And then after you do your projections, you know where your cost of production is, you need to do a business plan. And again, you might say, well, what's the sense of a business plan? Well, 80% of your work is done if you've done the income projection. And a business plan really amounts to these items. Now, what are we going to do for a business plan? Well, let's talk about doing some adjustments on the farm that maybe can bring more income, such as somatic cell count. Let's make a plan to lower the somatic cell count. In fact, in the future, you may not be able to sell milk if you have greater than 150 somatic cell count, or even 100. In fact, there's milk plants right now that are getting very specific. And I know a lot of farms that they're actually able to produce milk with less than 100 somatic cell count. So let's just talk about that as an example. It needs to be specific, measurable, achievable, realistic, and on a timely basis when you're going to get it done. So look at 3 or 4 items that you could pick that would look at doing a business plan and improving that cash flow on the farm at year end. Let's go on to the next one, if you would please, Sandy. And if we do a business plan, we do cash projections, We do realistic milk price, and there's certainly plenty of places we can look at what our projection it would be for milk price. People like Dr. Mark Stevenson has done projections. You can look at what the futures hold, talk to your lender, look at realistic expenses that you have on your farm, and look at items that you can put together in a business plan, maybe 3 or 4 items. You know, there's only about 20% of dairy producers out here that do any kind of a business plan, that do projections for this next year. As we go forward in the future, folks, that number's got to raise. You can't have 80% of the producers not doing it. You need to be in that 20%, and we need to bump that 20% higher. It's important to do your taxes for the IRS. You have an obligation just like everybody that has an income in this country has. You have to be able to ask intelligent questions to your accountant. You need to put together a list of items, an action list. You need to be aware of items. You need to be aware of earned income and appreciated income or net worth. Earned income is really what you show when you do a cash income statement. Appreciated net worth is if you bought land for $3,000 an acre and today it's worth $7,000, you can say, well, boy, I really did well when I look at my balance sheet. Well, did you really earn that, or were you just in the right place at the right time, particularly with land being as valuable today and as much in demand as it is? So I'm suggesting that if you haven't done the balance sheet, would you please do it for your own good, for your farm's good? Do the cash projections. Be in that 20%, and let's push that 20% to a higher number, and let's do it. The future in farming of all kinds is going to be in knowing your numbers, ladies and gentlemen. And it's going to be in managing numbers. Having good, accurate numbers and know what to do with those numbers to run your farm, to make it successful for now and hopefully for the next generation to come. So Sandy, with that, I am going to conclude our comments, and you may have questions out there. So let's hear what the many people that are listening in the audience would have for questions for us.
Thanks, Gary. And I would encourage all of you to go ahead and start typing questions into the chat box, because at the moment I don't have too many. I did have one comment from Katrina who wanted to thank you for talking about buying large items and borrowing money for those items. As she said, it doesn't get talked about enough.
That's a great statement. And I see that far too often over the last 30 years that I've been working with dairy producers. And you really need to have a heart-to-heart discussion with your accountant when you do those types of things, and the family, just to realize what you're setting yourself up to. It seems like the correct things to do, but boy, it sure can bite you when we see that dip in milk prices. So I appreciate that comment, and I hope that this is something on people's action list that they go see their accountant, that they make sure that they don't end up with getting in a bind on something like that.
And while we continue to monitor our chat, and then to honor the time, Jenny took back the screen because she does have a couple of quick announcements to give before we end. And hang on to, we're going to have another evaluation poll. But Jenny, go ahead and make your comments. And please, everybody online here, put your questions in the chat. This is your opportunity to use and abuse Gary. Gary,
Go ahead, Sandy.
I do have one question here. Did I understand that you have to show income for 10 years to qualify for Social Security?
Well, it has to be for 40 quarters. And if you do the math on that, that's a 10-year period of time. Now, you need to talk to your accountant. And here again, these laws change all the time. I mean, Congress writes the laws, and the accountants have to interpret what the IRS says based on that. Whether that can be split, if you take it for a certain period of time and then you don't pay Social Security, then you pick it up again. You need to talk to your accountant about that. And I really find that as a real concern as people get, again, towards the end of their farming period. Maybe they got 5 years left and they take a look and say, whoa, we've been not showing any income and not doing any Social Security because my farm is going to be my retirement program. My farm is my IRA. Well, all of a sudden it gets to be pretty serious then that, oh, it'd be nice to have some Social Security. And the other thing is let's make sure the spouse is being paid on a farm and that the spouse has Social Security. And I don't mean to do a guy and gal here thing, but all of our farm families work together very closely. Many farms, the wife does get a wage uh, on the farm and collects some for collecting Social Security. So make sure you have that discussion. Again, too many times that's forgotten about and not discussed early enough.
Gary, Sherry asks, is there a limit on section 179 for depreciation?
Yeah, there is going to be a limit on that. We've had times in the past where that has been as high as $500,000 depreciation. So theoretically, you could buy $500,000 worth of equipment and depreciate it all in 1 year. And of course, that all would come off your income. But the thing that we need to remember when you take depreciation is that you no need to go beyond what the income. I mean, if you zero out your income, you got to have income in order to take advantage of the depreciation. And here again, you need to talk with your accountant. And there are limits on the amount of 179 that you can take, and each year is different. And accountants get updates from the IRS a couple times a month, and sometimes once a week, depending on what's going on. And that's why it's absolutely important you just have a good relationship with your accountant and you understand where that is. And hopefully you can do that before the end of the year. Again, the horse is out of the barn right now, but certainly for future years, you need to take a look at that. So yes, there are limits on how much the 179 that you can take.
Heather put up our evaluation poll. I would ask you to go ahead and vote on that poll while we continue to take some questions here. Gary, is it better to pay your kids cash wages or make contributions to a Roth IRA?
When you look at the, and this gets into a financial advisor can give you some good information on this based on your individual tax situation. It's good to take and pay your children wages. They probably all have a Social Security number already and start to begin with. And you need to do both. There's the, particularly as many children, and hopefully they look at college or some type of further education of tech college or what have we in the future. There's the 529 that can be contributed to. Wisconsin has the program as well for education purposes. Children need to be paid a wage so they have a pretty good understanding of what's going on. And yes, there needs to be IRAs that are put together, but I would take a look at doing the 529 and getting those college funds put away. They need to have a savings account so they understand what's going on. In fact, I would suggest that the young people, probably when they get into maybe 7th, 8th grade, and individual families have to decide they ought to have a checking account. And then when they get into high school, and some listeners may disagree with me, I think they need to have a credit card or at least a debit card. And you need to work with them on that. I'm not talking about huge balances available, but some small balances, and have them go out and buy some clothing for themselves or gas for the car, whatever it is. And when that statement comes at the end of the month, show them why it's important to pay that off. A lot of people will prefer debit cards versus credit cards, but also credit cards helps you build a credit number. You have to have particularly if you borrow money in the future, you need to know where that number is. And this helps build that number as well. So before children leave for college or whatever further education, make sure they understand how to balance a checkbook, how to reconcile a checkbook, how to understand a debit card, and how to understand a credit card and pay things off. But definitely let's put some money away for those college funds, and the sooner the better. Grandparents, uh, when grandchildren are born, set up some type of an account, 529 account, so we have some money in the future, because we know that education, regardless of what goes on here in government programs, is going to be needed. Great question when it comes to young people.
And
And get the young people involved at the appropriate time to understanding the farm checkbook, understanding the farm balance sheet, understanding with borrowing, understanding the decision that goes in when people are borrowing money on a farm, whatever the asset is. But again, at the appropriate time, because this gets young people involved in the farm and they can see what's going on. So don't hide those things from them. Get them involved and they'll have a better understanding of what's happening.
and to that comment too, helping them to understand how to read the milk check. Like you said, understanding the true cost of production begins with understanding the milk check. And to that, I just need to do a plug for our upcoming coffee chat on February 8th with Mark Stevenson. We are going to be dissecting how to read and understand your milk check. Because from extension, I know lots of kids who never looked at it, never went over it with their parents. So they really don't know how that income is coming in, how it's divided out.
Yeah, that's great. And I would highly recommend people take Mark's session in, particularly as we look at the PPD on the milk check and how come that has just been all over the place. And Mark will even tell you that the federal marketing programs are pretty complicated, but he does a nice job of explaining things and sorting things out. So I certainly would give him a plug as well for people to listen to that and understand it.
Gary, is there a software program for the home computer that you would recommend for collecting data, doing balance sheets, etc.?
Well, we've talked about QuickBooks during the program here, and it's really a generic type of program. You have to be careful of some of the items you put in there. It's not going to be specific for dairy. Again, I'll talk about Red Wing out of Minnesota, without eliminating others, there are other programs that are out there, and I see a number of them. I would talk to your accountant and ask your accountant what they are familiar with, because obviously that information is going to be shared sooner or later with the accountant. So find out what types of programs they're familiar with and what they're dealing with and what they found farms to be successful with. And there's a learning curve of understanding these things. So don't be afraid of them. Find out what's there, what's going on, how to deal with it, and work with it. And I think Extension and other consultants would certainly be willing to work with producers of understanding the program. But get yourself a good spreadsheet program that you can put this together. We can do so many things today on the computer. And make sure, particularly if there's one that's developed at home, that the cells in it always are correct, that you're getting the proper information you can. So don't be afraid to put a pencil to some of these numbers once in a while to understand where the numbers are coming from, and you're getting accurate information. And I can't put enough emphasis on the word accuracy. As we look at today with an 85% expense rate on farms, just think we spend $1 and 85 cents of it goes to expenses and only 15 cents is left. Sometimes that's family living and a net profit on a farm. So we just need to understand those numbers today.
Jenny, do you want to go ahead with some of your comments here? And we'll continue to take questions while Jenny catches us up on a couple things.
Jenny, you're muted if you don't know.
Thanks, Gary. I did not know. I just wanted to follow through on what Sandy said. There are 2 more Heart of the Farm chats in this series. Mark Stevenson will be next month. And then we have Jenny Gavin from Gavin Farms in Reedsburg presenting in April on how to product and market, or how to market and brand your product. I also wanted to call attention to UW Extension Division of Extension's Farm Ready webinars coming up. They will be on topics of dairy and livestock management. I believe somebody, Trisha, were you going to put that into the chat where they can sign up for the farm management webinars? And with that, I think that we'll stay on if Gary can for a couple more questions. I did want to kind of say that I will put a list of resources for farm record keeping programs that I personally am aware of. So I teach QuickBooks is one of them. And then there is a whole list of other ones that I know other people across the state are using. So I will put that up on the Heart of the Farm website. And I see that Heather has put the link on for the Farm Ready research. Again, those are for dairy and livestock farm management topics, and they will be running through April. So with that, I'm going to turn it back to Sandy and Gary and anybody else who has some more questions on his presentation, and we'll just kind of go from there. Stay on as long as we have questions. Thank you.
Gary, is there a limit for how much a farmer can pay a child before the child must report it for income taxes?
There again, I'm going to pass that on to the accountant that you're working with. I'm not aware of just where that number is, but again, these change all the time, and it's important. And with that, let me just make a comment when we talk about farms going to the next generation farm transfer. I've worked with many farms, and of course, you work with the accountant, you work with the attorneys to getting things done right. But farm transfers are extremely important, and this may surprise people. I really believe that they need to be done before the first generation reaches the age of 60. I prefer 55, that's being started, because it may take 10 years for that transfer to occur. So if you're 55, how old are you going to be in 10 years? And there again, that's an important point to have the younger people understanding what's going on financially on the farm. Not only that they're workers on the farm, but they need to become decision makers, and they need to become people that understand what's happening. I think you'll find that they'll have a whole lot more interest if they, the sooner they get involved. But again, I made the comment when we started that there's going to be more questions for the accountant than I'm able to answer here, because of these tax laws changing so fast and so quickly. And of course, we've got a new administration coming on now, and we will certainly see some changes here as we get into this next year. It won't affect us until we get into the taxes that we're doing next year. But during the year, there may be some depreciation changes. There may be some other types of things that will occur. So we'll see where we go from there. So again, put these questions down, talk to your accountant, get them down so that you have this discussion and that you don't forget to ask them, and have your action list prepared for that accountant.
As Trisha put in the chat, this Friday, the Farm Management Friday session is with Kevin Bernhardt and Heather Schlusher, and they're going to be talking about long haul featuring cash flow. And I think that gets to what you were saying about projections for the new year.
Yeah, in fact, Kevin and I are going to be putting a session on here in the next couple of days with a group of dairy producers doing this very thing. He got a lot of good information. Half of his requirements are dealing with extension, and half is teaching at Platteville as a professor there. So again, gather as much information as you can when it comes to these types of programs. And if anything, this last year, and it's been a very difficult year, everyone understands that, but it's brought these kinds of presentations to everyone's office, that you can listen without having to take the day to travel someplace for an hour or a 3-hour discussion. So please take advantage of those and get yourself financially educated. There's no time like the present to do it.
I think I have caught all the questions, unless one of the educators is seeing something I didn't catch. And if not, or seeing nothing, we can close out our session. Gary, thank you very much for your time today.
Yes, thank you very much,
You're
Gary.
welcome. It's been a pleasure. And I just, again, understand the numbers, folks. A good time of year to get your head into it and run your farm based on the numbers and make decisions and get your plans.
So Todd asks a question, are the CFAP payments taxable? That's the
Here again, I'm going to go
CFAP.
to,
Yeah.
yeah, there again, ask your accountant that, because we just discovered here the last couple of weeks about the PPP payments. They were going to be taxable, and now we found out just shortly that some of them are not going to be taxable, and they're not going to have to show up as income. And again, depends on the level, depends on the farm. Great questions for the accountant. I guess I'm not going to go into areas that I am not familiar with, because these accountants spend a great deal of time of educating themselves, and there's so many moving parts to it. And I just hope I've stimulated people to ask questions, maybe things they haven't thought about before.
Katie Wantock from the Division of Extension, who does quite a bit of farm management programming, has indicated on the chat that yes, all government program payments are taxable income. And she's also putting up an online spot to go to through our extension. We have an extension article there that helps you.
Yeah, as people look at all the different income sources that they had this next year, make sure you've got them all separated out in categories so you know what they are, and they can be correctly discussed with the accountant when that comes in, so nothing is missed. We don't want anybody to miss something that is appropriate to be shown as income.
Yeah, Katie's listing the ARC and PLC program payments received October through November. CFAP 1 and CFAP 2 received June through December. MFP payments. Yeah.
That's exactly what we're talking about. You know, it's certain months it is, certain months it isn't. It's just a nightmare for the accountants.
It probably points
sort these things out.
It may point to the fact too, you really should select a farm accountant, not just Joe Blow bookkeeper on the corner who happens to do taxes, but somebody who's kept up with the farm accounting.
Boy, I'm sure glad you brought that up, and it's becoming more and more critical. And I have seen that in the past where someone was dealing with an accounting firm or person, and all of a sudden they went for different reasons, went to a farm accountant, and they've actually had to redo taxes going back as far as they could because deductions just were not taken the way they should. Things were not done correctly. That's an extremely good point. I mean, the farm taxes is not simple. It is complicated. Even depreciation schedules, my goodness, that's one area that accountants don't necessarily like a lot because, I mean, just think each piece of equipment has to have its own depreciation schedule, and it takes a lot of work just to get that done. And I know some of that can be automated, but it is so important to have someone that understands what's going on the farm. Just like a lender, you need to have a lender that understands farming. Very important today, as complicated as this world of agriculture has gotten, and we need to sort it out. Don't let it scare you, but get good people to work with you.